Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week for our live weekly update, just to keep you informed on what's going on in the markets and what we see coming up. There's obviously a lot to go through. We were off last week, so I apologize for that, but we'll get you caught up. And of course, we had a couple holidays, Canadian holiday, Victoria Day, and Memorial Day yesterday in the United States, so there's playing a little catch up behind those as well. So let's jump into things. And as always, keep in mind that everything we talk about on here is for information purposes only. Do your own due diligence or reach out to us. Remember, you can always go to us, go to our portal at mikeonmoney.com. Happy to answer any of your questions, look at your individual situation and see how we might be able to help out. Also, you can subscribe to our videos. These are all recorded. We have a lot of other educational material on our portal there. You can subscribe to our YouTube channel, or if you prefer, you can subscribe to our podcasts, where you can get all of these for easy listening while you're driving, or you're just trying to fall asleep. I'm told that I have that effect on people. But with that, let's jump into things. See what's going out on the economy. We are looking for some home price indexes out of the United States. For March, we actually saw some early numbers just before this video we started recording. Prices are up, volumes are down. A bit different than in Canada. We'll touch a little bit about the Canadian market, but they're still seeing the price index, or the overall price in the United States, still going up a little bit. We're going to look at the manufacturing index for May, and also look at the consumer confidence for May. And we're also looking at Canada's GDP for May. So a lot of economic numbers coming in. One thing to keep in mind, we've been talking about for the last several months, are we going to go into a recession due to this inflation and increased interest rates? There's still a strong possibility of that. In fact, I would argue we've already entered one, or we already started one. But keep in mind, all these indexes that we're looking at for May numbers, even if we see negative numbers there, a recession is only when you have 3 consecutive months of negative growth in the economy. So you don't actually know you're in a recession to almost, if it's a short recession, almost when you're coming out. And that's kind of what we're expecting. Even if we orchestrate a soft landing and we don't get 3 months of negative growth in a row, we might only get 2. We won't know when we're coming out of that based on the GDP or growth numbers until it's over. So you have to adjust ahead of time. Keep that in mind. Even if you're seeing or hearing positive things, that might be for 3-4 months ahead from now, after we go through a potential recession or a soft landing, and that's still a big debate right now. So when it comes to the stocks, we saw a pretty good rally last week, and we saw things head into the long weekend with some pretty good numbers, which was great. Gave the market and gave some investors a breather. We certainly took it as an opportunity to make some minor changes, move out of a couple of positions that we weren't, we were looking at other areas of growth or stronger dividend. We're really looking at the cash flow companies these days, looking for those strong dividend pairs and where we can take advantage of that. I don't know if this rally is going to hold. In fact, today's been a bit negative. Not a big surprise. Generally, a day after a long weekend, people kind of reassess, especially when you had a nice Green Friday. Canada was up yesterday, generally due to the lack of volumes with U.S. and Americans being away, not playing in the market. So that's not a big surprise. We're seeing a little bit, not a big sell-off today, but certainly we're seeing some negative numbers. Oil continues to rise. We'll talk a bit more about oil. This is kind of going counterintuitive to what's going on in the markets, but we all know we have that supply crunch. We had that before we went into this year. We had it before we went into the Ukraine situation, and all that's being exacerbated. So we continue to see oil do well, and we'll talk a little bit more about what we see in those numbers. As I mentioned, yesterday was Memorial Day down in the United States. The first trading day of the week was closed, so Today's the day, definitely seeing a little bit of sell-off, still on the concerns of that high inflation and what that might cause the Fed to lead the Fed to do as far as interest rate hikes later this year. So where's the safe house? Well, rising rates are definitely testing the foundation for the property boom. As I mentioned, in the US, the pricing's still moving up, but we're not seeing that in Canada. We've actually seen the table turn. It's not in correction territory. It's not in crash territory at all by any means, but we're definitely seeing those volumes fall off. A typical house in Toronto would have fetched 40 offers, bidding wars overnight, just a few months ago. Now we're seeing them go no bid for days, kind of back to what some people might call the normal market. So we've definitely seen, or at least the shorter term peak in pricing in Canada, as we're starting to see those prices pull back. You're starting to see price reductions on homes. People are in situations where they've bought another property and they have to sell. So they're putting price reductions out there to try to get some interest from buyers. And buyers, I said, a bit on the sideline for a couple of reasons. Obviously the higher interest rates are impacting borrowing capabilities. So they're being a little tighter with their wallet when it comes to the price they're willing to pay on homes. But also there's that expectation that we are going to see a pullback in housing prices. So people are saying, well, maybe I'll wait 6 months, maybe I'll wait a year and see where housing prices, will land. And all that is, a bit self-perpetuating as we see more and more of that, buyers not being there, more price reductions and bringing things down. So hopefully we'll get a little bit more clarity as to what the trend is there over the coming months. But do keep that in mind. We are definitely seeing the house prices off their peaks in Canada for sure. And of course, the Ukraine conflict continues and it's reshaping things like the global market. Russia's invasion has caused countries, especially in Europe, to look for alternative suppliers. Africa is definitely stepping up to meet European demand. And, Moscow, Russia, being stung by those European sanctions, being cut off by pipelines, being cut off by shipping routes, are increasingly tapping into risky ship-to-ship transfers of the oil to sell it into Asia, where China is still a big buyer. They still have an agreement with Russia, and China's buying a lot of their oil. But to get it there, they don't have as many direct routes, so they're having to transfer the oil at open sea. So a lot of problems with that. There's also some conflicts over which country's ships might be involved, and I'm sure we'll get more information out of that. But the thing to keep in mind is we're still seeing that strong oil market, even though we're starting to see shifting global distribution. Other news in the US, the labor market's still pretty hot. We're seeing decline in profits overshadow the economy right now, but we're still seeing the unemployment numbers dropping. Fewer and fewer people going to collect unemployment benefits. But keep an eye on those earnings reports, because as companies' profits decline, of course, that turns over their hiring habits. They'll either leave, not hire as many people, or start, trying to pay less. As they start to build a more efficient business to compensate for those lower profits, it does, tend to turn the dial on unemployment and start to rise again. And that's really what we're seeing the economy trying to do is cut off that inflation number. They need to bring unemployment up a little bit. Doesn't mean we want to go back up into double digits, but it's down to about 2.5%. We want to bring that back up a little bit and just slow down that hot employment market. U.S. retailer earnings, are just showing, that gap between shoppers and inflation. As inflation surged, we're still seeing pretty good retail numbers out there last week. Kind of showing that split between people shopping. The less affluent who are being impacted more and more, and the more affluent who are still out there paying high ticket numbers on high end products. So it's the start, right? It's the start of higher interest rates and inflation to affect those retail shoppers. We really haven't seen it in the numbers yet, but it's something we should expect to see a bit more as time goes on. OPEC is sticking to their modest output hike, so they're really keeping a clamp down on supply. Keeping that price of oil up. They have a meeting on June 2nd. They'll look at the July output, but they're still targeting, fairly mild increases as far as supply goes. And that's where we're seeing oil. I think we saw it spike through 118 this morning US dollars. So now that we're solidly above the 110 a barrel, this is where we're going to have to really keep an eye on oil. Now, you've heard me talk about it before. I've been bullish since last fall, and we've seen great numbers out of those stocks and performing. Those stocks pretty much at all-time high, all-time earnings. We haven't started to trim yet, but now that we've broken through the 110, keeping a really close eye on that, because it has to be sustainable. It can't just be a continuous straight line up. So be cautious. Depends on your weightings you might have into the oil sectors, and depending on where you bought in, I might start recommending you keep a close eye on that and start trimming a little bit anyway over the next month or two. That doesn't mean I'm negative on oil. Oil does not have to crash for profits to drop, or even the oil price to come down a bit. Just be careful of all-time highs as we start to push back to the highs of the last oil rally. Don't keep your feet in there, both feet in there, for too long. It's okay to have exposures, but be cautious as to how much exposure you might have. If you've done really well in that area, that's great. Be thankful that you took advantage of that, and it starts to consider trimming over the next month. I'd say we'll talk more about it over the next couple of videos, but keep that one in mind as we move forward. Russia is prepared to seize firms that are looking to leave. So this goes back to the beginning of the sanctions. Of course, we saw a lot of companies shut down their businesses. McDonald's, Nike, Coca-Cola, the list goes on and on in Russia, kind of to follow the sanctions that the Western countries have put in on Russia right now. And we've even seen other companies take bigger steps. McDonald's being kind of the first big one, Starbucks following, selling off their properties and closing them permanently. Was that a big a business decision around what's going on there, or was it a preemptive move, figuring that Russia's pushing this new law in where they're they can just seize those businesses? So McDonald's being able to sell at least for some value their properties and business there before Russia just takes it away, nationalizes them, or sells them off themselves, and just takes it away from them. So if this law continues to push through, there'll be probably a lot more companies trying to sell off their assets there ahead of this law, and those who might not get there might have those businesses taken away regardless. So what the advice there is follow pretty much the same suit that has been going on for a couple of months now. Is if you're looking at a company that does business in Russia, really take a look at how much revenue is coming out of theirs towards their numbers, and discount that off appropriately to make sure it's still a good buy. Oil snaps its inverse dollar link. So, this just goes with US dollar. Generally, when the US dollar is on a bull run, oil weakens a little bit just because it's priced in US dollars. That's not been happening because we've had this short, supply crunch on oil at the same time that we have a, big concern bear market kind of overbearing everyone's outlook. So the flight to safety to the US dollar. So we have both of them moving up at the same time, or staying strong at the same time, at least. So we've got that inverse relationship broken a little bit. And that's kind of my comment back to the oil pricing of, if you are heavy in there, take it off a little bit, because that inverse relationship is going to come back. Don't know when, but it will come back. So just keep that in mind when we're looking at the price of oil. There is some pressure with a strong US dollar there as well. So let's take a look at what else is going on this coming week. Coming up in the US, as the personal consumption expenditure price index for April is going to be released to see where people are spending their money. It does exclude volatile food and energy components. So, probably where most people are spending their money these days, but it's not in there. But we're tracking both those really closely. Personal income is expected, to remain pretty unchanged for April from the previous month. Again, things just leveling off. Even though we see those unemployment numbers dropping a little bit, we're not seeing the income going up. The consumer spending report is showing still pretty strong. Most activity, there are pockets of slowdown, but things still moving forward. We actually, one interesting company that's reporting this week is Pinduoduo. So this is an Asian kind of farm to table technology tracking food consumption directly from the farm through distribution to your table. We're looking at probably a first quarter hurt by stiff competition and also less discretionary money. So this is where we're going to start to see that inflation impact first, or the most, is the more the higher end. Is there easier, cheaper options out there? We'll start to see people move their spending habits from kind of that discretionary spending to non-discretionary spending. So we're expecting companies like this to be impacted pretty quickly, as it is a luxury. Chip maker Broadcom is looking to buy VMware. So if we've been following, the chip businesses, there've been a lot of acquisitions, moves to acquire more manufacturing to keep up with demand. And Broadcom's expanded out to the cloud business by buying VMware for about $61 billion. So an expansion and more consolidation in that business, and we'll see, or in that industry, and we'll likely see much more in there, just like we saw a lot of that in the oil and gas industry late last year as they started to really ramp up. The Elon Musk Twitter story must continue. Of course, it's ongoing. It's almost painful. So if you've been following this, Elon Musk has a $44 billion takeout bid on accepted offer on Twitter, which translates to roughly $54 a share. Obviously, the stocks trade much below that. That's the market saying we don't think that this might happen. And just a layer of twist into that, the Twitter stockholders are suing Musk for manipulating the stock price by him and Han about that. They're saying he's going to go ahead, saying he's going to reprice it. All these things that are affecting people's outlook or pricing of the stock. And was that honest information, or was it used to really manipulate the stock to get him a cheaper deal? That lawsuit's going to go forward, so we'll see where that lands. Macy's actually raising profit outlook pretty much the first time since the pandemic, mostly on high fashion pickup. So kind of goes contrary to what we've been talking about of people moving away from the high end spend. But really, what this is coming from is the pent up wedding demand, social events, kind of more the affluent part of the economy or of the population, spending above and beyond the inflation numbers, just to get back out there into the social trends, especially the more formal ones. So probably, we saw this a lot through the pandemic reopening, where we see the backlog of demand, pick things up, send the numbers soaring, and then they peter off, quickly after. So be a little cautious. Might be, if you own Macy's, and we see some good upticks in their prices, might be an opportunity to sell into good news and look for pullback there afterwards. McDonald's, was going through a board battle, and shareholders re-elected their director as Icon loses the board battle. So a lot of going on with McDonald's. They've been struggling a little bit. Obviously, pulling out of Russia was impact on their earnings as well. So we'll see how this plays out with once things calm down in the board and they get a little bit more stable management going on there. U.S. dollar stores are expected to put out higher earnings as inflation continues to surge, pushing people to shop more frugally. So no big surprise here. I think it was actually Buffett who coined the phrase that he would go out every Saturday morning to the Walmart and sit in the parking lot and look how many Mercedes were parked in the parking lot. And his view was the more and more people started to look for discount, that's when the economy was going to turn over a little bit, that people were going to stop shopping at the high end stores and start looking for value. And this is pretty much the play here. The dollar stores, people are going to look to save money, not spend as much at the big chain retailers, or sorry, the discretionary, more expensive retailers, and look for discounts. So we are looking for better earnings from the dollar store there. In Canada, the Canadian banks shrink their future bad debt cushion as the economic risk continue to mount. So Canadian banks all had wrapped up their second quarter earnings last week. Pretty much across the board, better than expected profits, a lot of dividend increases. So all good news from that front. They did reduce the amount that they put aside for future loan losses, raising the question, are they taking into account the potential looming risk to its full potential? I say they're definitely looking at it wisely. I think they've gone through their book with a fine-tooth comb. I think they feel that they've got a comfortable cushion there, so they didn't need as much. Even though they are expecting some impact, I think they're well positioned still. So that's just my view. But happy to discuss that with anyone in more detail should you have any questions. And Malaysia's Petronas is looking to trade some with Canada for LNG. And this is pretty much ramping up. This goes to of course, Ukraine-Russia situation, the LNG contracts in Europe. Everyone's kind of looking for other sources. So Canada is well poised in that front to take advantage of that with a strong LNG market up north that's been really trying to, get its legs under it and build out more. And this might be an opportunity for them. On the exchange front, as I mentioned, the U.S. dollar still showing strong support, in this unknown period, that flight to safety. Even though we're seeing the higher oil prices, as I mentioned, that inverse relationship has kind of decreased temporarily. The EU's decision to place a partial embargo on oil prices oil imports from Russia has also, increased concerns and risk around the Eurozone growth. And if you've been following us for the last couple of months, we've definitely been light, almost exiting our euro exposures. Not completely, but for the most part, just due to that concern. The impact of this inflation and this conflict is much bigger on the European countries than it is on the North American. Even though we're seeing it over here, the impact's a lot bigger there, not just on their economies, but their currencies. So, it will be a good opportunity at some point, but we're still being really conservative there. Government bonds rose again after a 3-day break, pretty much lifted by the hawkish speech by the Fed Reserve that they need to, rise interest rates, a bit further. And if you're following that, of course, Canada's about to increase their rates again this week. It's fully expected we're going to see another 0.5% this week. And likely the US Fed to follow. So that's all priced into the market, so I wouldn't be concerned about that. Really what we wanted to pay a big attention to is what the language is after these hikes, what they're going to be signaling next, because there's a lot of indicators right now indicating that we might see them not be as aggressive for the second half of the year as originally expected. Now, it doesn't mean it's going to happen. Doesn't mean that that's guaranteed in pocket. The market's kind of already priced in a pretty aggressive second half of the year, but it's starting to show signs that we might not have as much of interest rate hikes in 2022 as expected. So if that were to happen, we will see some nice rallies, especially in the fixed income markets. As that pricing comes off those markets and we get a yield curve move. So again, we won't know until after they both hike and we start to hear the language afterwards and see the effect of these hikes. But a little bit of optimism for the second half of this year when it comes to interest rates. We might see that news get a little bit better. We talked about oil, $118 and on the rise. And metals, little change, as far as the pricing there. Still cautionary. Inflation headwinds are still there, but demand is still pretty strong. We haven't played the metals as much. Oil's definitely been the better market to be in, when we look at resources. So we've been focusing on that front. With that, thank you very much. If you have any questions, as always, go to michaelonmoney.com. More than happy to hear from you. And you can access all our other videos and find out and subscribe to videos and podcasts from there. But with that, I know today was a bit of a catch up and a little bit longer, but I'll let you go enjoy your days, and I will talk to you again soon. Thanks. Bye.